Good morning. Let's talk about the global financial markets today, Wednesday, July 2nd, 2025. Over the past 24 to 48 hours, global financial markets have been highly dynamic and complex. In the United States, equity markets showed mixed results. The Dow Jones Industrial Average continued to climb, while the S&P 500 and Nasdaq Composite pulled back from recent highs. This divergence signals a sector rotation, with investors moving money out of high-growth technology stocks and into more cyclical and defensive sectors. In the bond market, United States Treasury yields rose after stronger than expected job data, which reduced immediate expectations for Federal Reserve rate cuts, though a cut in September is still widely anticipated. Meanwhile, the United States dollar continued to weaken, benefiting other major currencies and emerging markets. Geopolitical tensions, especially around United States trade tariffs, remain a significant source of uncertainty. The current market environment is shaped by a resilient labor market, mixed manufacturing data, major fiscal policy changes, and escalating trade rhetoric. The Federal Reserve's policy path is being influenced by these external factors, especially trade policy, while liquidity conditions in the repurchase markets are normalizing. Looking ahead, we expect continued sector rotation in equities, with value and cyclical stocks likely to gain further. Bond yields should remain firm and sensitive to labor market data and Federal Reserve commentary. The United States dollar is likely to stay weak, creating trading opportunities. Investors should closely watch key economic data releases and the upcoming United States tariff deadline, as these could drive significant market moves. Actionable opportunities include long positions in cyclical and healthcare equities, high yield and emerging market bonds, and certain currency pairs like British pound United States dollar, Euro United States dollar, and New Zealand dollar United States dollar, while considering hedges or shorts in some technology stocks. Zooming in on the United States stock market, we saw a mixed trading day. The S&P 500 slipped for the first time in 4 days, while the Dow advanced and the Russell Index of smaller companies also rose. The Nasdaq fell, mainly due to weakness in major technology companies, while the Dow was supported by gains in healthcare. This shift shows investors are moving away from high-growth tech stocks and into more stable, value-oriented sectors. The outperformance of small caps over tech is the largest since April, reflecting caution about high-tech valuations and a preference for sectors that benefit from current economic conditions, even if rate cuts are delayed. Sector churn continued, with consumer staples, materials, and healthcare rising, while technology and communication services fell. Notable decliners included Tesla, which dropped after political tensions and scrutiny over subsidies, and MicroStrategy, which fell alongside Bitcoin. Major chip makers and tech giants like Nvidia, Broadcom, Meta, Microsoft, and Alphabet also lost ground. The Williams companies dropped after an executive shakeup, and Axon Enterprise declined despite strong revenue growth. On the positive side, healthcare stocks like UnitedHealth, Amgen, and Merck boosted the Dow. Casino and resort operators surged after strong Macau gaming revenue, and Builders First Source jumped on optimism from a Senate tax bill and low mortgage rates. Packaging Corporation of America rose after an acquisition announcement, and automakers General Motors and Ford gained. Verint Systems spiked on acquisition talks. Looking at the second quarter, stocks rebounded strongly after April's tariff-driven sell-off. Growth stocks outperformed value stocks, reversing the previous quarter's trend. The technology sector rebounded, and other strong sectors included communication services, consumer cyclicals, and industrials. Despite concerns about growth, inflation, and valuations, the market showed resilience and optimism. The S&P 500 formed a bullish technical pattern, but the immediate outlook remains volatile and tactical. In Europe, futures for the S&P 500 and Dow rose, and major European indices like the Stoxx Europe, FTSE 100, CAC 40, and DAX all gained. Some European stocks rose sharply while others declined. European equities underperformed the United States in the second quarter but still posted modest gains, partly due to a stronger euro and policy divergence between the European Central Bank and the Federal Reserve. Asian markets were mixed as the United States tariff deadline approached. Japan's Nikkei fell on trade jitters, while Hong Kong and Australia advanced. South Korea and India declined, with Indian markets dragged down by financial and infrastructure stocks. In the second quarter, developed and emerging markets outside the United States outperformed, though Chinese markets lagged. Easing United States-China trade tensions and a weaker dollar boosted emerging market equities. Asian equities saw strong returns, especially in local currencies, helped by currency appreciation in Taiwan and Korea. The mixed performance in Asia, especially Japan and India, is closely tied to United States trade policy risks. In fixed income, United States Treasury yields rose after strong job data, with 2-year, 10-year, and 30-year yields all moving higher. This rise is directly linked to the unexpected increase in job openings, which reduced the likelihood of immediate Federal Reserve rate cuts. The bond market remains highly sensitive to labor data, with strong employment pushing yields up and delaying monetary easing. In Europe, German and British yields fluctuated. In the second quarter, United States bond indices gained, with high-yield bonds outperforming investment-grade ones due to tighter credit spreads and shorter durations. Municipal bonds were volatile, losing value due to concerns over tax status and new issuance, while emerging market local currency bonds performed well, thanks to a weaker United States dollar. Global bond funds also saw gains. The United States dollar continued to weaken, ending the quarter down. This trend is driven by political interference concerns, fiscal uncertainty, and expectations of Federal Reserve rate cuts. The president's push for rate cuts and a large projected deficit add to these pressures, as does a recent credit rating downgrade. Dollar weakness benefits foreign assets, especially in emerging markets. Major currency pairs reflected these trends. The British pound and euro gained against the dollar, supported by strong domestic data and policy divergence. The pound-United States dollar pair traded near multi-year highs, and the euro-United States dollar pair reached levels not seen in years. The Australian and Canadian dollars benefited from risk-on sentiment and positive trade developments. The Swiss franc strengthened as a safe haven, and the Japanese yen saw volatility due to policy divergence with the United States. Overall, currency markets are being driven by central bank policy differences and shifts in global risk appetite. In commodities, oil prices rose and then fell slightly as Middle East tensions eased, reducing inflation concerns. Gold prices climbed for a second day, acting as both an inflation hedge and a safe haven amid fiscal and geopolitical uncertainty. Silver slipped slightly, and cryptocurrencies like Bitcoin and Ether declined, mirroring the tech stock pullback and showing their continued sensitivity to risk sentiment. Key United States economic data included a rise in job openings, signaling labor market strength and reducing stagflation risk. This pushed bond yields higher and delayed rate cut expectations. Manufacturing data showed continued contraction, highlighting sector weakness, possibly due to tariffs. Construction spending fell, reflecting ongoing housing affordability issues. Consumer sentiment improved, but remains below previous highs, and core inflation remains persistent. The Federal Reserve's GDP growth estimate was revised down, indicating softer momentum despite a strong labor market. Federal Reserve Chair Jerome Powell reiterated a cautious stance, noting that trade policy is now a major constraint on monetary policy. The market sees a low chance of a rate cut at the next meeting, but expects at least one by September. The European Central Bank and Bank of England are also signaling gradual easing, while the Bank of Japan remains ultra-loose, supporting the dollar-yen pair. The Canadian, Australian, and Swiss central banks are reacting more to domestic data and global risk sentiment. On the political front, the president's tax and spending bill passed the Senate, adding to deficit concerns and raising the risk of further credit downgrades and higher borrowing costs. Trade tensions remain high, with the president sticking to the tariff deadline and threatening new duties, especially on Japan. Conflicting signals from officials add to market uncertainty. Easing Middle East tensions have helped oil prices, but geopolitical risks remain. In monetary operations, usage of the Federal Reserve's overnight repurchase facility dropped sharply, reflecting a shift by money market funds into short-term treasuries as yields became more attractive. The Federal Reserve is adjusting its operations to ensure liquidity, and the trend toward normalization may slow as treasury balances stabilize. Looking forward, expect continued sector rotation, with cyclical and value stocks likely to outperform tech and growth names. the Dow may remain strong, while the Nasdaq could stay under pressure. Volatility is likely to persist as investors await clarity on fiscal policy and labor data. Bond yields should stay firm if labor data remains strong, and the dollar is expected to remain weak, especially against the pound, euro, and New Zealand dollar. The dollar-yen pair may be an exception due to policy divergence. Key events to watch include the private payrolls report, the June jobs report, and the tariff deadline. Strong jobs data could reinforce expectations for a hawkish Federal Reserve and further fuel sector rotation. Any surprises on tariffs could trigger rapid market swings. Actionable strategies include going long on cyclical and healthcare stocks, high-yield and emerging market bonds, and select currency pairs. Consider hedging or shorting overvalued tech stocks, and maintain exposure to gold as a hedge against inflation and instability. In summary, the past 2 days have seen a complex mix of equity divergence, rising bond yields, and a weakening dollar. Sector rotation is underway, driven by labor market strength and valuation concerns. Bond and currency markets are highly sensitive to data and policy signals. Political and fiscal developments are key sources of uncertainty. Looking ahead, volatility and sector shifts are likely to continue, with opportunities in resilient equities, higher-yielding bonds, and select currencies.